Okay, canceling mortgage insurance. This is a big one, and there's a lot of confusion out there as to how it works. You should think of it in two ways. Number one is sort of a natural cancellation where the loan amount has been paid down to a certain percentage relative to the original purchase price or the original appraised value on the purchase transaction. The other side is sort of an appreciation calculation, right? This is when the loan balance has achieved a certain percentage relative to what the property is worth now. And how it is determined what it is worth now is generally via an appraisal paid for by the borrower. So, in the first option, without a new appraisal and going off the original value of the home, we'll call it original value, that's probably just going to be the purchase price. Once the loan balance is paid down to 78% of the purchase price, the mortgage insurance will be automatically canceled. Once it's paid down to 80% of that purchase price, the borrower may request it to be canceled. And whether or not they approve it probably depends on how far into the mortgage they are, right? And if they've established a timely payment history. Okay, and then the second way to cancel mortgage insurance is really based on a scenario where the home has appreciated, right? You haven't paid down the balance to a certain percentage threshold, but the balance is of a certain percentage relative to what the property is now worth, right? This happened quite a bit during COVID. People who bought right before COVID and whose homes appreciated wildly during that time, they achieved an LTV, or a loan to value, the inverse of a down payment, of well below the threshold where mortgage insurance should go away. So now turning the page, how mortgage insurance can be canceled based on an appreciation factor of the current value, not tied back to the purchase price. If within 2 years of owning the home, the borrower tries to have mortgage insurance canceled, they must establish that the loan balance is now below 75% of the appraised value. So if the home is appraising for $100,000, the loan balance should be below $75,000. At that point, the mortgage insurance could be canceled. And after 5 years, the borrower does the same exact analysis, only they only have to establish that the loan balance is 80% or below of the current value. Remember, in both of these scenarios, the borrower is paying for an appraisal, and an appraisal is usually about $650. So if they're getting an appraisal and it's in aims of canceling or remaining $300 on the mortgage insurance, it might not be worth it. If you have a borrower who is asking about having mortgage insurance canceled, please direct them to me and I can kind of guide them in whether or not it's worth it to pay for that appraisal.